Welcome to Academic Gain Tutorials. In this video, we will discuss about mortgage points explained like you're 15. When you hear the word mortgage points, it may sound confusing, but the idea is actually simple. A mortgage point is an upfront fee you pay to the lender so you can lower your interest rate. In easy words, you pay more money at the beginning so you may pay less every month later. Usually, one mortgage point equals 1% of your loan amount. For example, if your loan is $300,000, then 1 point costs $3,000. This amount is normally paid at closing, when the mortgage is finalized. Now, why would someone pay extra money up front? The main reason is to get a lower interest rate. When the interest rate becomes lower, the monthly mortgage payment can also become lower. Over time, this lower payment may help you save money, especially if you keep the mortgage for many years. So, the process works step by step. First, you choose a mortgage. Then, you decide whether you want to buy points. After that, you pay the points at closing. In return, the lender lowers your interest rate. As a result, your monthly payment drops, and the savings can build over time. For example, imagine you take a $300,000 mortgage. Without points, your interest rate may be 6.5%, and your monthly payment may be around $1,896. In this case, you pay $0 for points. However, if you buy 1 point, you may pay $3,000 upfront. In return, your rate may drop from 6.5% to 6.25%. Because of that lower rate, your monthly payment may fall to around $1,847. That means you save about $49 per month. At first, that may not sound huge. But remember, you paid $3,000 upfront to save $49 every month. So now the important question is, how long will it take to recover that $3,000? This is called the break-even point. The break-even point tells you how long it takes for your monthly savings to equal the upfront cost of the points. In this example, $3,000 divided by $49 is about 61 months. That is around 5 years. Therefore, if you stay in the home and keep the same mortgage for longer than 5 years, buying the point may help you save money. But if you move, sell the home, or refinance before 5 years, you may not get enough savings to cover the upfront cost. Because of this, mortgage points may make sense in some situations. They may be useful if you plan to stay in the home for a long time, if you want a lower monthly payment, if you have extra cash at closing, and if your goal is long-term savings. On the other hand, mortgage points may not make sense if you may move soon, refinance soon, or need to keep more cash available for emergencies, furniture, repairs, or other home costs. Also, if you will not stay past the break-even point, paying for points may not be worth it. Another thing to remember is that points are optional in many loans. You do not always have to buy them. Also, each lender may offer different interest rates, different point costs, and different savings. So, one lender's offer may not match another lender's offer. Also, a lower interest rate is not always worth the upfront cost. Some buyers focus only on the lower rate and forget to calculate how long it will take to recover the money paid upfront. This is why you should always compare total costs, not just the monthly payment. So, before buying mortgage points, ask 3 simple questions. How much will the points cost upfront? How much will the monthly payment decrease? And how long do I plan to keep the home or mortgage? These questions will help you understand whether points are a smart deal or just an extra cost. In simple terms, mortgage points are like paying in advance for a lower interest rate. They can save money, but only if you stay in the loan long enough. If you leave the loan too early, the upfront cost may be bigger than the savings. This video is for educational purposes only. Mortgage rates, points, payments, and savings can vary by lender, borrower, credit profile, loan type, location, and market conditions. Always compare offers carefully and speak with a qualified mortgage or financial professional before making a borrowing decision. If this short video was helpful, give it a thumbs up and subscribe to the channel. Thank you.